Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office July 2024 First Friday meeting. Today's presentation is titled Looking Stupid versus Being Stupid. Today, we are going to try a slightly different format by including a very intelligent financial professional by the name of Matthew Daly. Matthew is going to go through a short list of questions he has curated from the financial community. Our goal is to ensure the decision makers of families served by the Abernathy Group Family Office have relevant data, not hype or biased information, which will allow them to make intelligent decisions and preserve their wealth. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked for the recording. Our comments today will be approximately 25 minutes long, leaving us plenty of time to take questions from participants. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of prepared remarks by clicking on the react or reaction icon at the bottom of the screen. I wanted to remind you that we really do enjoy your questions, and we will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and distracting. With that said, let me turn the presentation over to Matthew Daly and Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen, and I'll try to go first. This is the July 2024 First Friday meeting for the Abernathy Group Family Office members, and just as a short reminder to everyone, this is our 21st monthly meeting, and all of the meetings recordings, they're available on our YouTube channel and on our website. And by the way, just as an aside, if you haven't been to our website lately, please consider visiting. It's a new website, and there's a wealth of information on how to continue your personal journey of becoming an intelligent investor. And there's some information on estate planning ideas. There's a new section on how to reduce your retirement plan costs while improving your 401k plan for your employees, for those of you who are business owners. And today, so visit the website if you have a chance. It might be worth your while. There's a lot of information there, and we keep it updated pretty regularly. Today, as Marissa said, we're going to offer a slightly different format for the meeting, as we believe it is likely to provide material or different material or better material, with the goal of, as always, enabling you to make more intelligent financial decisions by following the data and the signals and ignoring the noise and the biased information from the press. That really is distracting, and it's getting in the way for people making intelligent decisions. So we've invited someone that I've known for years, who's intellectually honest and devoted to data and the truth, just about as much as anybody I know. We've invited him to participate in our call as the master of ceremonies, or the co-host of the call. He's going to introduce the topics and the questions, along with the additional perspectives that I, as a lot of you will say, may often overlook. So we're gonna continue with this format for the next 3 months. Afterward, we'll determine if the format is offering better information. We'll talk to you guys and figure out whether you like it better or worse. If it's better, it's going to justify our continuing with this format, or if not, we'll revert back to the previous format. So just to introduce Matt, he specialized in international relations and economics in college. After he went to the dark side, of Wall Street on the trading desk at UBS, where he rose through the ranks until he finally saw the light and moved into the world of management consulting. So his specialty was financial restructuring, and mainly for energy companies. He co-founded and ran a health technology software startup after that. And just my quick summary is, Matt brings a fairly broad spectrum of experience to bear on the problem-solving intricacies of investing, along with what I would claim to be the uncertainty and the politics and technology that are imposed on each of us as decision makers. So we're going to leave it to Matt to introduce the questions we believe to be important to the Abernathy Group family office decision makers, and also to make sure that we answer the questions along with any attendant additional questions which surface from our answers or from the audience. So with that said, Matt, let me turn it over to you and let's get started.
Thank you, Stephen. That was a very glamorous introduction. I'm not sure if I'm deserving, but nonetheless, we'll get started.
Okay.
Today's topic is fashioned after the article written by Palm Valley Capital entitled The Art of Looking Stupid. In the article, they remind us that Wall Street is comprised of some very intelligent individuals, some would say amongst the best in the world. And as consequence of being very good at what they do, they don't like to look stupid. They are an incredibly competitive cast of characters. This competitiveness creates a psychological illness called the fear of missing out, or colloquially known as FOMO, which creates its own problems, usually ending in extreme outcomes and often ending in tears. This illness causes intelligent humans to engage in some incredibly stupid activities. And these incredibly stupid activities are not contained to the self-proclaimed geniuses on Wall Street. The investing public, more often than not, is pulled into the irresistible fear of missing out, of FOMO. Also because they think the Wall Street professionals know something individual investors don't know. Time passes, and the cumulative activity of Wall Street and the investing public pushes prices to extremes based on emotions and the illusions of future profits, which never arrive. It is at this wily coyote moment when the coyote realizes he has gone too far chasing the uncatchable roadrunner. The market soon realizes the siren song of its profits to come is a mirage, and those participating in this mirage of future profits move into the being stupid category, with regrettable losses easily avoided, and which would have been gladly avoided by ignoring FOMO and looking stupid on the way up to nosebleed prices, rather than being stupid in the end by paying regrettable prices for assets, which always lead to losses. I think we're seeing that today. Today, we are going to discuss 4 topics, each of which, when answered correctly, may have significant implications on our financial markets, on our US economy, and a broader global economy, which is very interconnected as a whole, and eventually on our wealth. The main topics we will start with are, first and foremost, we have been in a record-setting market for the last 6 months, and we have had more than 30 new record highs during those 6 months. What event will give this bull market the ability to go higher, and why do investors always seem to overpay for stocks? Next, what we'll do is we'll talk about what event is most likely to force this bull market to move lower, or what could happen to change the current strong economy narrative. Third, we'll talk about inflation. It's a big topic now, and it has been for at least the last 2 or 3 years. On the one hand, the US Federal Reserve is determined to fight inflation, which means slowing our economy. Over the last 80 plus years, 80% of the time, the US Federal Reserve has sent us into a recession or depression when trying to control inflation. We see cracks forming in our economy already, and inflation seems to be declining, although it's been elevated to 30 or 40-year high just in the last couple of years. So can the US avoid a recession and kill inflation simultaneously? And if not, which evil is the lesser evil? Continue with higher inflation than planned, or a full-on recession? Finally, we will end with a short discussion on the presidential election by discussing the fact that there is a lot of contention in this election. Is this normal? If not, will it lead to volatility? If there is significant volatility, how is this contention most likely to affect the financial markets and the broader economy? So with that said, let's get into the first question. Given the 30 record-setting market peaks over the last 6 months, what event will give this bull market the ability to go higher? And as a follow-on question, why do investors always overpay for stocks and assets in general? Stephen?
Well, let me answer the follow-on question first. We'll just do it in reverse order because I think it might
Sure.
lead into the answer to the second question. I have a feeling that the simplest answer describing the reasons investors often overpay for financial assets um, and are surprised, as we talked about last month about the surprises. Why are we always surprised? They're just surprised when they realize they overpaid. Um, and I think that problem is, well, as you described it, Matt, FOMO, fear of missing out. So I I I will admit that herd mentality or FOMO is really hard to ignore. The combination of the talking heads describing the markets as a thrilling place to gamble, and by they want to encourage you to place bets on whether the next hour or the next day will be, the stock market's going to be up or down. It's created the gamification of investing, and that's a shame. Everyone wants to win the game. Naturally, I get it. Um, but it's not what the market was created for. The FOMO is supported by something called recency bias, which convinces most individuals that the information that they seen most recently is the most important information in your decision making process, and that's rarely the case. For instance, when the talking heads on television talk about a stock that they were screaming about yesterday and it went up 5%. So, um, it's likely to go up again and again today. Um, and they will start screaming again, it's likely to continue on its path. Everybody starts believing that just because, what happened yesterday is forwarded into the front of your brain. Even professionals get caught up in this hype. Despite the fact that as you think about it, just for a moment, higher prices mean both higher risks and lower future returns. And it's not a combination that any investor should welcome. You should try to be paying lower prices with higher future returns. So the bottom line is that most people believe the FOMO psychology is driven by greed. We believe it's more likely driven as much by envy as anything else. And the reason for that is there's nothing worse than seeing your neighbor or your coworkers getting rich as the stock market increases in value while you sit on the sidelines waiting for a decline in the values, which allows you to have a risk reward ratio which is favorable. Uh, and every week the market hits new highs while the talking heads on TV and the journalists and the press continue to create titillating headlines. And, as they scream, don't let this market pass you by. So, while each of us knows that paying more for an asset increases our risk and simultaneously decreases our expected returns, it's just hard to resist. However, as we discussed in our last webinar, the illusion of wealth creation and FOMO creates a siren song of prosperity and riches to come. And it just doesn't last. And for those who take the bait and overpay for the long-term assets, they tend to regret their actions and ending up asking themselves why they listened. So FOMO is a derivative of herd mentality, and the vast majority of all humans avoid this in their everyday lives. When you see prices elevated at the grocery store, you avoid it. When you see prices elevated at the clothing store, you wait for things to go on sale. Um, the majority of people during their everyday lives walk away from these offerings. However, when the talking heads or the press note that X company is trading at $100 a share and they tell you that they believe it's worth $150 a share, FOMO sets in. So avoiding herd mentality trap, and the FOMO trap is incredibly important if you want to be a successful investor. This Warren Buffett-like talent is essential for every investor interested in making intelligent investments and avoiding FOMO. So, Matt, let's. I think that I think I tried to cover the last portion of that, and let me leave it to you. Do you want to cover the first portion of this question, or what are you thinking? You might be on mute.
Apologies. Yeah, no, I
It's all
think
right.
that you did a good job there. But let's discuss the event that is potentially most likely to make the bull market defy the fundamentals and move higher.
Yeah, yeah. As most of you know, I've been discussing the fact that prices remain elevated and they're sort of two standard deviations, not to get too technical, but they're two standard deviations or more above fair value, which is not a recipe for anyone to be interested in paying those prices. So the most likely event to increase prices further, which could happen, will be a decline in interest rates and a continuation of the U.S. government spending money to stimulate our economy. So we believe, and we hope we're wrong, that the Fed is so afraid to allow our economy to enter recession, and during that session, allow our economy to reset, allow the bad companies to go away, allow the good companies to prosper. They will lower rates and create quantitative easing 5 or quantitative easing 6, despite the long-term consequences of not being able to repay our debt. So they'll create more debt and lower interest rates at the first sign of bad news. I think that's the good news for those overly invested in the market today. The bad news, I think, is that this is the wrong reason for the market to move higher. The main fundamental reason for an asset price to increase in value is for their expected earnings to increase. You pay $100 for an asset and it earns $10. In order to make that asset worth more than $100, you have to be convinced that the $10 in earnings is going to become more than that. Currently, the stock market has already priced in an earnings increase of 10% a year in 24 and 12% a year in 2025. We don't believe this is the most likely outcome. In fact, we believe this is an incredibly unlikely outcome. And I want to underline incredibly. It's not impossible, it's just incredibly unlikely. Why? The Fed created an inverted yield curve, which is doing its job. The economy is slowing. The current earnings gains for the broad market are being generated by 10 to 20 different companies, while the rest, meaning the other 480 companies in the S&P 500, are increasing earnings at a rate of sort of that 1 to 3% range, or many are losing money. We believe that recency bias is persuading the investing public to believe that because the last few years witnessed earnings increases in that 10% range, it'll continue. However, the investing public is forgetting that the earnings increase was generated by 3 tailwinds, which are really unlikely to be available moving forward. That's
Sorry to interject, Stephen, but what are those tailwinds that you're talking about?
Oh yeah, sure. Yeah, we discussed them before, but let me just remind you that over the course of the last 20 years, companies have been adding leverage hand over fist. Their balance sheets are stretched, they're levered up, and when you lever up like this and interest rates fall, it allows your earnings to increase as if they're on steroids. We've also had a 25% lower tax rate. And as many of you who own and run companies know, as a tax rate decreases, those earnings fall, those savings fall right to the bottom line. So higher leverage with lower rates allowed corporate America to leverage profitability. Then we lowered taxes, which allowed more profits to drop directly to the bottom line. And my point is that these three gifts created a virtuous cycle of tailwinds that are unlikely to be duplicated during the next 5 to 10 years. It's more likely that these tailwinds of the last 20 years will become headwinds as we struggle to repay the debt we created at the corporate level and at our country's level. So in summary, we believe the US Federal Reserve is afraid of a recession, and regardless of inflation levels, will cut rates as soon as recessionary confirmations materialize. These rate cuts will initially cause the market to increase in value, yet soon thereafter, I think the world will easily see that earnings the talking heads and journalists thought were growing were created by stimulus and inflation. And they were illusions created by the debt creation and lower interest rates. So that's, I think that's the right, that's what we believe is happening. Matt, do you think that answers the question, or do you have a little bit different take, or anything to add?
No, I think that's about right. And I think, just without getting off topic, but going into geopolitical stuff, as as we maintain our hegemonic status, meaning the United States, we kind of have these luxuries to, don't forget, just a few years ago, we're accusing China of manipulating currency for their excessive inflation. But I think, as much as some talking heads may want to panic and say that this is evaporating before our eyes, there is definitely a few years in front of us. I don't think it's an immediate concern, but I think you're essentially spot on in the current situation that we have. So in that sense, I'll move on to the next bit, which is, despite all the government manipulation and money printing, which may or may not continue, depending, what do you think has the highest probability of allowing the overvalued markets to become more fairly valued? And how far do the markets have to decline to get to fair valuation, in your view?
Gotcha. So this is an interesting question, because there's such a long list of negatives staring us in the face. Most investors would tell you the market should be undervalued if they just wrote down the risks that are right in front of us. So if they were going to combine all the possible events which could actually happen, I think it would terrify most people. So of course, as Elroy Dimpson said, risk means more things can happen than will happen. So that's an important, famous quote that all of us financial people understand. Yet in today's leveraged world, events, we believe, may start to cascade into each other, creating vicious circles where one event seemingly that's unrelated tends to create another unwelcomed event. Of course, that's not our prediction, yet it is one dimension of risk most investors are not considering, yet they should at least consider this as an outcome that could be embraced. So most investors don't respect the fact that difficult times are normal facets of the business cycle. And just because we've had several decades of negative events, which were miraculously fixed by the money printing of the United States Federal Reserve, this option may soon come, or I guess I would say may at some point become unavailable. So the events which worry us and could easily become the reason for the market to become fairly valued or undervalued are certainly geopolitical risks. We've got a hot war in Ukraine. We've got a war in Armenia, Croatia, Israel, and there's always the risk, although I think it's a long shot, of a war in Taiwan. Certainly, we've got recession risks. It's I think it's a higher risk than most people have planned for, but it is in our sort of work, we believe it's among the most important risks to plan for. Additionally, we're spending 2 trillion plus or more each year than we make. And when the world stops buying our bonds, a very difficult set of questions are going to confront us, as interest rates at that point may become 8 to 12%. The world with, and if they stop buying our bonds, they may only start if we offer rates that are much higher than today's rates. That is horrible. A lot of you haven't thought about it, but over 70 countries this year, all around the world, will elect new leaders in 2024. How will those elections take place? Don't know. Upsets could shake the world. The United Kingdom just received a stark wake-up call just this morning, and there are more to follow. The stock market is setting price records based on 10 to 20 companies, while the other 480 struggle. At some point, either the earnings will broaden out and the other 480 will start to participate, or the market will collapse on itself, as history is full of examples where narrow advances, mostly related to AI, artificial intelligence, lead to tumultuous downturns. And then there's the bankruptcy cycle. So statistics clearly show that over 30% of the Russell 2000 publicly traded companies were not profitable when interest rates were 0% or were near 0%. And I just want to bring this to your attention that when unprofitable companies have to refinance their leveraged debt, now at rates that are 5 to 8% higher than their former rates, it's more likely that our economy will enter a period where bankruptcies take place each week. And that's not going to help our narrative or our disposition, that's for sure. So in short, the list is long. The leverage in our system is at record highs in dollar terms and in relation to our GDP, both. In fact, our debt load is categorically unsustainable. The question becomes, when will the world realize this? And I fear that will be the moment we want to avoid.
Okay, thank you. I think I'm hearing a lot of risks, inflationary risks, credit risks, etc. Maybe we can briefly maybe we can briefly discuss what this means in terms of how much lower valuations could go, especially in the US market, or maybe
Yeah.
what valuation should be at, given everything that's going on and the plethora of risks that we've discussed and beyond.
Yes. Okay. A good point. Most of you have seen a slide that's similar to this. It changes each month, obviously, but fair value for our marketplace based on current earnings is approximately 25% lower than current prices. So that's if we got back to historically a 15 multiple of current earnings. If our earnings decline as we believe they will, again, don't forget, we don't have interest rates being lowered. We have high leverage, and it is quite unlikely that we're going to have lower tax rates than our current tax rates. If our earnings decline as we believe they will, lower prices will be welcomed or warranted. And if the decline starts, or if the decline unfolds, the narratives from the talking heads on TV and in the press, they're going to change their focus from putting a good spin on every single event every day to putting a horrible spin on every event. Don't forget, their goal is to sell ads, not provide valuable predictions. I mean, these are actors, they're not analysts. What does it mean? We think that a 25% decline could easily turn into a 50% decline, as history shows that most downturns overshoot fair value due to the changing narrative. And it takes time to restore confidence. This is not a glass half empty conversation or a scaremongering. It's just math. In short, history shows that fair value is about 15 times current earnings. The question is, what will earnings become? And will the narrative around those earnings be positive, supporting less pain, or will they be negative, supporting a lower multiple of earnings between 10 to 15 times? And will that satisfy the marketplace at that time? So I don't know whether that answers the question, or Matt, push back if there's more that needs to be talked about.
No, I think that does answer the question, and I do agree. But I think one thing maybe, and you've alluded to it, but this is both. That's a logical answer, and I think that's the correct answer. But there's two sides to this coin, and we've seen a lot of it with, it's both a political question and what's going to happen, and what benefits the political side and what actually benefits the economy and the U.S. citizenry, if you will. So, every day the U.S. Federal Reserve faces a decision. Do we continue to slow the economy and increase the risk of recession, or do we fear the risk of recession enough to allow inflation to continue at current or even higher levels?
Yeah. I think this is a really easy one, and lots of you on the call are going to push back and say that maybe you disagree. But the U.S. Federal Reserve believes inflation has been dealt with, and I believe that they're going to lower rates the first sign of any kind of financial distress. Why? I think the Federal Reserve believes the combination of the inverted yield curve, the increase in housing costs, and the rent increases and debt repayments have allowed the U.S. consumers to spend all of the stimulus money, which fell from helicopters over the last few years. And I think the Federal Reserve is convinced that they've dealt with inflation. They also believe employment levels are at or near 20-year highs, and those levels they really are wonderful, and they will keep our economy out of recession. We don't see it exactly like that, but the U.S. Federal Reserve's belief allows them to fear less about inflation flaring back up, and I think they fear a recession more. So if the Fed is equally confident about avoiding a recession on the one hand and avoiding inflation flaring up on the other, which decision carries the lower risk and the mildest consequences if it comes to pass? And here's where some of you may get upset with me, but it's just math. Game theory clearly shows that there are two logical reasons front and center, both of which favor the Fed and and tax the citizenry. Reason one, avoid a recession. Here's the reason. If we fall into a recession, tax dollars fall. We already have a budget deficit exceeding $2 trillion for 2025. And during recessions, deficits tend to increase by 4 to 7%, depending upon the severity of the recession. Add another 4 to 7% to a $2 trillion number, and you start getting, numbers that are almost incomprehensible. With our current debt obligations, we can't afford to increase our deficit. And I think the US Fed is going to do whatever is necessary to avoid this calamity. The second reason may be the more important of the two. Inflation allows the US governments to repay its debt at some time in the future with inflated dollars. For instance, each year of 4% inflation actually reduces our debt by approximately 4%. With the government or with the current levels of debt, the only way our government will be able to repay over $35 trillion in debt is to inflate our debt away. And by the way, that's not including our Social Security sort of plans, or none of the social programs are included in that $35 trillion number. So if you say it a little differently, inflation is a silent tax on the citizens of the country experiencing the inflation. And since raising taxes is a terrible subject for political reasons, governments resort to inflation to repay their debt, as opposed to telling the citizens they are going to raise taxes and they're going to cut spending, cut social programs. That's not a winning message. In summary, if the decision becomes higher than normal inflation or a US recession, we firmly believe the US Federal Reserve will choose higher than normal inflation, and it's probably, I would say, it's probably the right decision, because staying or maintaining higher inflation tends to help us pay back our debts, and it's our only way out. Matt, so do you feel differently about that? Does that sound reasonable to you, or is there a different take?
I think you're right, and I would agree. Again, it's one of those things that it can be influenced. What you've outlaid, I think, is the logical, progression. When politics are involved in the government and societal sentiments, it gets a little bit more complicated, a little bit harder to predict. But I generally think you're correct, and I think that's, and just to relate it a little bit to, for example, the pandemic is in everybody's recent memory, and 2 weeks to stop the spreads turned into 2 years of lockdowns, and it had a bunch of detrimental effects, which we don't need to get into. But it's the correlation I'm trying to make is that people got used to it pretty quickly. It was a massive change in lifestyle, changed everything, but people adapted, and people are still in existence, I would argue, because we're very adaptable. And inflation is a little bit easier, although people, lots of people are upset about it now because prices have jumped on food and several essentials 25% or more over the last 3 years. But when you talk about it as a 4%, which is, I think, is roughly where it's at now, and target inflation historically is around 2 or 2.1%. 4% inflation, even though it's double that, I think it's it's underneath the common understanding, I think, where people could adapt to it. And it's a better way, rather than almost everybody understands, my taxes went way up. I'm not happy about that. So in summary, I think you're pretty spot on. And I think that's definitely the logical way to go about it. Of course, we'll see, but I would, if I had to guess, I would guess that's the way will play out. And again, there's political ramifications there. So I think that's a perfect segue into our last topic scheduled for today, which is focusing on the current November presidential election our country is embarking on. And to describe this election, which is a rematch of our last one, it involves two candidates that polling shows 70% of citizens in America do not want to vote for either. And neither party wants their candidate to run for president, yet here we are. Whomever is elected will inherit a budget deficit over $2 trillion. That's trillion with a T by some accounts. Two hot wars ongoing, couple potential threats to come, and the assurance that nearly 50% of Americans will not be happy regardless of who wins. So, Stephen, what are the tea leaves telling you about what we have in front of us?
Okay, so let me also say that for those attending, if there are other views on some of these topics, please don't hesitate to raise your hand or to come back to us, because this is the format that we want to sort of allow talk and discourse. It's important. So it feels like, so we're not political here. We take the data that are giving us, or that are given to us, and we try to understand what that means. This is a very uncomfortable position for the world's leading country to be in. I think it's almost, it borders on embarrassing, because it has similarities to the antics frequently seen and experienced in South America, along with other third world countries. I know that may not be a popular opinion, but it some of the things that are going on are just embarrassing. The other day, someone in our office said last week, or gave me a quote that I thought was worth repeating, and they said that the election this year is between two people no one wants to win, and based on our economic situation, it's between two people who shouldn't want to win, meaning whoever gets in is going to be inheriting a $2 trillion deficit, and 50% of the country that just doesn't want them to be in office. Yet here we are. So this incredibly important event is sort of disguised in the typical veil of uncertainty. The events between now and the end are going to play out in a way, as said, leaving 50%, at least 50% of Americans displeased or uncomfortable. And to make matters potentially more uncertain, US voters aren't even sure who the candidates will be based on one of the two parties' current deliberations. So we believe the chances for conflict around the elections is higher than normal. That creates additional risks for the capital markets. And again, it seems like I'm being a glass half empty guy, and I'm not trying to. I'm just trying to. I guess we're erring on the side of risk avoidance, because most of the families here that we serve are in that portion of their life. But it's clear that the differences between the haves and the have-nots is stark, and both sides are currently being emboldened by the recent riots that focused on Israel hot war and the justice system's handling of these riots or protests. In some ways, it feels like our nation has become almost lawless. And personally, again, I don't want to put too much of my personal input here, but when I see rioters attack police or any entity in our country that has been hired to protect the U.S. citizens, I truly begin to lose faith in our governing system. I mean, I think that's again, I'm definitely not a defund the police person. I think that they should be given a lot of respect, and when they tell you to stand down, I think that you should stand down. And if you don't stand down, I think that they have to protect themselves. And I would challenge anyone on this call to walk in their shoes for a couple of days. Anyway, however, here's what history tells us. This is the important part for all of us as investors. History clearly shows that there's no significantly different outcome regarding which side wins, as both as long as Congress is split. Corporations are intelligent. They adapt to laws They change their way of working. They change their domicile sometimes. They're intelligent, living, breathing beings or entities. When both houses of Congress are controlled by either party, by one party, the outcomes are much more volatile. Sometimes they're good, sometimes they're less good. So I believe the most important thought or advice I could offer is that the odds of more market volatility, they've increased. Be aware of that. Check your comfort level for volatility or for downturns, and just make sure that you're comfortable with having a significant portion of that of your portfolio go away. Maybe it'll come back, but maybe not. Maybe it'll take a while. The odds of conflict inside our country they've definitely increased, and the odds that the rest of the world will continue to envy us as the shining star of capitalism, thus value our assets with the same amount of esteem as they have during the last 20 years, I think that's decreased. I believe that we've lost some minor amount of envy. Matt, this is way more in your sort of category of expertise than mine. You're much more well educated than I am about the political environment. Do you have any words of wisdom for the families we serve in our family office that might be a little bit more upbeat than mine?
I don't know about more upbeat, but I think it's a cautionary tale. It's not an immediate doom situation, but I would definitely recommend caution and also close attention to broader geopolitical issues, as you alluded to there. I think we're starting to lose our luster a little bit. If you look at things like, I don't want to deep dive into it, but the loss of the petrodollar, Saudi Arabia, that's a big affront. And that's an ally, or was, or it's kind of in a gray area now, I suppose. But them, having China and India buy oil in Saudi Arabian rials is would normally be a big news item, and it's would be considered by most as a big affront. What the economic ramifications of that are, obviously it's less trading of the US dollar, but the broader and more long-term stuff will remain to be seen. But I think it's partially our news coverage, but it's also partially what's actually happening. I think a lot of people around the world are kind of confused about what's happening here and what's been happening here for the last 3, 4, 5, 6, 7 years. That does present a danger. And the rest of the world is much more in tune with what's going on in the world. The United States, we have the advantage of being the global superpower, and all of us basically have been so our entire lives. So we tend to think less so about what's going on in the rest of the world. We don't need to be as in touch with it. But the rest of the world, meaning other countries, do pay attention to what's happening around the globe because it's much more relevant to them. So they know what's going on here. And I think while it's not a doomsday situation yet, nothing is going to tear us down. I think it's definitely something that needs to be paid attention to. And definitely with that perspective in mind that other people are watching. And it will have impacts eventually. And how we respond and what we do in the future is going to impact that.
Well said. Yeah. Marissa, did anybody have any questions, or does anybody have anything to say to push back on what we've talked about today? I'm curious.
No questions have been submitted yet, but if anyone would like to ask any now, that would be a good time.
Okay, so as long as there are no questions and if there are some things privately that you'd like to talk about. As you all know, our phones are always open and ready. Um, please, please be safe. Please take a sort of a look at your portfolios over time and give us a call and talk to us about your acceptable levels of regret. I think that is the right way to put it. And we'll look forward to seeing you at and next month on the call. Bye now.